But at the start of the program, we are going to look at what Shaktikanta Das, who's the 25th governor of the Reserve Bank of India, as well as the current incumbent governor of the Reserve Bank of India, what exactly he said recently about whether India needs a credit upgrade. He was speaking to a television channel, a private television channel, a business television channel, and this is what he spoke about. He said that India's macroeconomic fundamentals are very strong. As a result of that, growth momentum too is very strong. All these seem to indicate that India is doing really well. International investors' confidence is also very strong. Clear indications that India definitely looks like it needs an upgrade. There's huge foreign exchange reserves, and that gives confidence to international investors. India is also well positioned, he says, to service its external payment obligations. Hence, with such a large reserve of foreign currencies, India can, as a result of that, indulge itself in the external markets. Now, also, a rating upgrade should have happened much earlier, is what he said, given the fact that this is not the story of India today, it's the story of India for a reasonable period of time. And the government too has been very clear in its policies, especially on the fiscal consolidation part. We are seeing that in the budgets, that the target now of reducing fiscal deficit to 4.5% by 25-26 is on track, and the government is moving in the right direction to achieve all its targets. This is what Shaktikanta Das says. So the RBI, keeping a track of the Indian economy, seems to clearly see that all the indications are right. Credit rating agencies have an influence, we know, over investor decisions and also borrowing costs of particular countries. But whether those are truly, a clear picture of what an investor will be looking at, most of the big international investors, they conduct their own analysis and they make their own decisions as a result of that and make their investments accordingly. The RBI's primary duty, is what the RBI governor says, is to ensure that there is financial stability within the country. So let's take a look really at what India's rating is currently. S&P, that Standard & Poor's, has rated India at BBB minus with a positive outlook. So they've changed it from stable to positive quite recently at the end of May this year. Fitch has a BBB minus rating with a stable outlook. Moody's has a Baa3 rating and a stable outlook. But we must understand that BBB minus, in fact, is the lowest investor grade rating that any country can have. This is not, what we've seen countries of the size of India having in the past. All former fifth largest economies had much higher ratings. Ratings reflect the economic size and also the ability to repay. And just as I've been talking about for the last few minutes, we can clearly see that India is well poised to repay all its debts. So fifth largest economies, in fact, were rated AAA or AAA ratings in the past. Time now to talk to our guest, Dr. Charan Singh, who's the CEO of eGrow Foundation, an eminent economist. He knows a thing or two about these numbers. So let's ask him straight off the bat. Dr. Charan Singh, do ratings matter that much, or do investors know, by their gut, this is where my money needs to go, and this is the country that has the best chance of growing?
Actually, both of them are important. I must admit with you that foreign exchange reserves, good fiscal policy, obviously leads to very good ratings. The non-performing assets of the banks are coming down. The buffers are very high. The inflation figure is much under control vis-a-vis the rest of the world. Obviously, these are very good economic factors which justify a very good rating. But despite these very good indicators, one has to admit the growth rate in the economy has been so strong, the continuity in policy and the stability in the fiscal and monetary policy of the country has been so good that the flow of money into the stock market, obviously, irrespective of the rating, is going to take place. So if you look at what has been happening in our country, in the stock market, which is one indicator of how rest of the world looks at you, it has been very, very positive. So I would say that both matter. If the ratings are very high, then of course the rate of interest, if one of the companies is looking for borrowing from abroad, it becomes easy. But when it comes to the question of investment, I think the flow of investment has been so good in our country that though the rating agencies have not raised the ratings, they have not done it despite the governor saying, and obviously the figures have been there for long. Look at the growth rate figures which we had in the previous year. Despite that, they have not raised it to where it should prudently be. But the flow of resources in the country has been continuous.
Indeed, Dr. Charan Singh, are ratings influenced, these agencies, are they influenced by preconceived ideas about large developing economies? Because not only India, China also had this problem and they were also growing and they also had a lower rating. Because they may be concerned that, large countries need to feed and care for massive populations. But these populations are also seen, as markets which are waiting to be tapped.
Absolutely, absolutely. I totally agree with you. Means India, look at the country like India, it has one of the best regulators, the RBI and the SEBI and even insurance regulator. Look at the type of industries, look at the stock market indices, look at the companies which are in the stock market. If you look at the complete plethora of things, the banking institutions, the regulation and supervision of those, you look at the complete ecosystem that is there in the country, is so rich. And therefore, obviously the rating should have been very high. But as you rightly said, and I have no qualms in mentioning, that there is a bias against emerging countries.
Yes.
The advanced countries somehow always carry a doubt whether this is the right thing or not. And the rating agencies play to the gallery and do not really give the right rating agencies. And if you look at the defaults that have taken place in Europe, now who can forget Greece? Despite that, now where did the rating agencies show us in advance that that's a red light area, you should not go there? Nobody showed us the red light there.
Absolutely.
But when it comes to emerging countries like India, nothing is happening, nothing untoward is happening, and still there's cautious. And as you were mentioning in your rating, some of these rating agencies put us at the lowest ebb of the investment grade. That is why for some time, many of us are questioning the people in the rating agencies, their expertise, and their assessment matrix.
Okay, I'm going to put you in the spot, Dr. Charan Singh. What do you think should be the appropriate credit rating for India?
Means I would rate it amongst the best in the world today. The market is moving. Everything that should be stable is stable in terms of fiscal deficit, in terms of inflation. We are doing very well. Foreign exchange reserves the import cover is very, very high. There's policy continuity and policy stability.
Right.
Look at the policies. There's such a huge it's a continent-sized country. There's been a political event which has been very, very large. All sort of political parties are playing a role, different ideologies. You see the smooth transition in the government. So therefore, what else does the world need to look at? And that is what is reflected in the stock market when it moves. Because the transition is so smooth despite all odds. That's why I say India deserves a very good rating. The next point I'd like to mention is the growth rate. Look at the growth rate. Even IMF has raised the growth rate. For many countries it is low. It's lowered for Japan, it's lowered for USA. But for India, it has raised it. Incidentally, it has raised for China too. But if you look at a long-term trend of growth projections done by the IMF till 2029, you find that India has been raised to 7, which I'm sure we're going to surpass. Okay. But even in the next 5 years, it's 6.5. Whereas for China, we increased it this year, but over a 5-year period, they are keeping the other end.
Dr. Charan Singh, in fact, we do have a story on China, so I'll bring you in on that as well. Do stay with us. The Chinese economy has depended on exports for